Okay, good afternoon, everybody. Welcome to the Centennial State and Liquid Investment Pool 2025 Market Outlook. We appreciate everybody joining and an ongoing commitment to keep the local governments here in Colorado up to speed on what's happening in the national economy, the local economy, as well as the fixed income markets. Our goal is to put on educational events, whether in person or virtually, as often as possible for the sole purpose of keeping you guys informed of everything going on out there so you can make the best decisions possible for your taxpayers. And prior to introducing our investment advisor and portfolio strategist, wanted to just give you a quick overview that the Centennial State Liquid Investment Pool, or
Oh no, it's
CSLIP,
coming.
is the newest local government investment pool in
No,
Colorado. We saw an opportunity to provide local
no, it's working
governments
right now. Yes.
with another option. And Max from Piper,
Okay.
you want to go ahead
Let
and
me
mute,
close this.
please?
Okay. Thank you. No
Thanks,
speaking.
Max. I'm going to go ahead and mute you. Okay. But we wanted to provide local governments with another liquid investment option for your public funds. And we feel that we've assembled a very, very fantastic board of trustees led by Bill Sutter, our chair at Boulder Valley School District. And you can see the rest of the board, which we do have quite a few of them on the call today, as the governance of the fund. And we have assembled a team of independent experts in the field. And one of those service providers is on the phone today, which we feel really provides us with a unique and different approach to managing a local government investment pool, which is daily liquid and a stable NAV of $1. And we feel that we have hired the best asset manager on the planet, given that they're the fourth largest asset manager on the planet. So William Goldthwait joins us today, and he is the portfolio strategist for CSLIP, and he's the vice president at State Street Global Advisors. He's on the global cash and global fixed income management team. He's responsible for the communication of cash and fixed income investment strategy, not only for CSLIP, but for their global cash business, performance to clients, consults, and prospects. He covers multiple sectors and vehicles, including both active and index fixed income. And prior to joining State Street in 2014, Will spent time on both the advisory and brokerage side of asset management. Most recently, he was a part of the Royal Bank of Scotland's institutional fixed income team and Merrill Lynch's institutional money market sales team. Prior to Merrill Lynch, he worked as a money market portfolio manager and fixed income trader for Columbia Management and Fleet Investment Advisors. So, really, you have 33 years of fixed income experience here. In one of the most remarkable humans I've had the privilege of interacting with over the last year as we were putting CSLIP together, and we're honored to have him today to give you an update. And we're going to keep this really in a podcast kind of webinar format, but there will be time for questions at the end, and we encourage you to ask questions if you have any. So with that, I'm going to hand it over to Will.
Thanks, Ben. Great to be here, everybody. I'm sorry, but I do have to read a little disclaimer. My compliance folks make me do this. So before we get started, I must let you know the information on this webinar is intended for the confidential use of clients and prospects of CSLIP. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited without the permission of CSLIP. Comments made by Ben and I are our opinions and not that of their representative firms, CSLIP and State Street. So the comments do not constitute investment advice or analytical research and should not be relied upon as such. And we're recording this on February 27th at 2 p.m. Mountain Time. So sorry about that. I forgot that I had to do that, so I'm glad I remembered. Otherwise, I'd be in trouble with the compliance police. But great to be here, Ben. I don't know, where should we kick this off?
Well, I think a question that we're getting a lot, not only here locally, but probably at your end on the national level, is tariffs. A lot of talk about those recently. Maybe you can shed some light for our attendees today on tariffs and what you think about them and the potential impact they may have.
Yeah, it's a great question. It's definitely the number one thing that we're talking about here. as it could very much impact investment outcomes. And so we're really focused on trying to understand it. So where we are right now is I'll just sort of level set on what tariffs can do, and then how they can be disruptive. So tariffs can be a one-time price adjustment. In other words, if one country decides to impose a tariff on another country, then and that tariff is set to be 10%, 20%, 5%, whatever percentage on a good that's imported from that country, then that can be a simply one-time price adjustment, and that's not inflationary. And I bear with me for a second here as we sort of walk through that. If you know that the cost of your import is going to go up by a certain percentage, then you can put that in your business plan, you can put that in your financials, and you can calculate how you move forward with that. And so that can be, either not have an impact or have a significant impact, but either way, there's a known outcome. And I think that's the thing that's really important to understand about tariffs is that they don't have to be disruptive. The part that's challenging, I think, where we are right now is it appears as though tariffs are being used as a negotiating tool. And so what it's doing is it's creating uncertainty. And I think what we're seeing when we hear interviews with business leaders and from local leaders is that they're less certain on the cost of things going forward because they're not sure whether there's going to be a price increase or whether prices are going to stay the same. And if they do increase, how much are they going to increase by? And then is there certainty that they won't increase again is if there's an additional tariff layered on? So I think that's why we're starting to see the market get a little bit more nervous about the talk around tariffs. I think there's no question that everybody wants to see more high-skilled manufacturing jobs, high-skilled production jobs move back to the United States. But it's going to take a while for that to work through. And with this uncertainty right now, the business confidence that we saw post-election and into the new year is starting to fray a little bit as people are starting to get worried about the implementation of tariffs and what does that implementation look like, and then ultimately how does that impact long-term prices. So we are starting to see some inflation concerns through survey. It's not in the data yet. We're not seeing an uptick in prices in the data yet, but we are starting to see it in the survey data. So in other words, you go out and survey a CEO of a company and you say, how are you thinking about inflation this year, next year, in 5 years, in 10 years? This year, next year, they're not worried because they've stockpiled, they've built inventories. But next year, the year after, longer term inflation expectations are starting to rise.
Okay. Yeah. I mean, that's definitely a really timely topic. And another topic that we're really hearing about out there, and it's all over the news, Doge.
Mm.
What are your thoughts on Doge, Will?
Yeah, I think, everyone, well, not everyone, but a lot of folks are in agreement that we want efficiency, right? We want efficiency and we want things to be efficient. We want to see things run smoothly. And we want, as a taxpayer, we want to get the most value for our dollar, right? I'm talking to treasurers on this line. You understand taxpayers are funding your operation, and so you want to deliver value for them. So I think the intent is good. I think the execution is a little chaotic, or maybe a lot chaotic, depending on where you are. Um, and so I think that's another thing that's adding a lot of uncertainty to the market right now. So I think ultimately, the end result might be good. I was just speaking with a treasurer in the state of Texas yesterday, and they're very much hoping that there's some real efficiencies that are created. Government has gotten really big over the last 15 years, really since the great financial crisis. We've seen an enormous amount of government spending. We've seen enormous growth in the government sector. And so if we can create some efficiencies, then that could be a good thing. I think it's the uncertainty that's causing challenges right now, and how we think that uncertainty might play out. And I see someone has disagreed with me, and that's totally fine. I welcome that disagreement and happy to discuss. And I think that's part of this whole process, right? Is we want to be able to discuss and talk it through, and sort of make rational decisions. But from a market standpoint, I think the way that Doge is being laid out is causing a lot of uncertainty. It's causing a lot of chaos, and that's making markets a little nervous.
Yeah, and I think it's going to be an ongoing, topic, and I think you mentioned something there that, really sparks my mind is how is this going to develop? What is the true impact going to have? And, with large initiatives like this, and even sometimes small ones, the trickle down effect can be months, years, sometimes even a decade, and it's really getting interesting, and as mentioned at the beginning of the call, if you have questions, feel free to either chime in or we can wait till the end. We want to address them. That's why we're doing this, is getting the, local governments in Colorado, on a forum here to discuss. This might be a good time to talk about, the FOMC policy. Well, what a dramatic change from the last webinar we did back in the fourth quarter, and then the educational event that we did in December. I think at the time the forecast kind of general consensus out there was for two rate cuts throughout 2025. And I think that has really may have changed. So can you talk to us about what you're seeing in the FOMC policy forecast for rates this year, and thoughts there? I think it'd be
Yeah.
really helpful.
No, absolutely. It's great. So Chair Powell, after the November meeting, and then even after the December meeting, and then once again in January, has reiterated that it's too soon for them to take anything that's being talked about from a legislative standpoint or from an executive order standpoint and turn that into monetary policy. In other words, we don't know yet what impact all of these programs, all of the executive orders, or all of this legislative action is going to have on the economy just yet. That's going to take 6 to 12 months before that starts to really have an impact. So what the market has been doing is speculating on the direction this government policy is going to take us. So that speculation led us to believe that the Fed would not be cutting. 3 weeks ago, the market didn't think the Fed was going to cut until early as September of this year.
Mm.
Now there's a little bit more of a chance that a cut could come as early as May, June. And I think the reason for that is because people are starting to worry about growth. They're starting to worry about economic impact, and the possibility of a slowdown in economic growth, just given sort of the chaos that is unfolding in Washington and with policy and how policy is getting implemented. And so with that weakness in growth, that then brings forward some rate cuts. State Street Global Advisors chief economist, she thinks the Fed will cut 3 times this year.
Mm.
That's an outlier view right now. That's an outlier view. There's a lot of people think that they won't. I've seen some researchers say they don't think the Fed cuts at all this year. So we think from a positioning standpoint, we think that we're being respectful of market pricing right now. We're moving our duration to more of a neutral position. In other words, we think the outcomes could be varied. We could see rate cuts this year. We're anticipating, that's our base case, is that we're going to see rate cuts, but the speed of those cuts we're just unclear on. So therefore, we're really trying to put some strategic duration in the portfolio, but we're also trying to buy some floating rate notes as well and hedge against that uncertainty in the direction of rates, to maintain that yield and try to deliver yield to the shareholders of the liquidity pool. So that's kind of how we're positioned right now, Ben, is that our house call is 3 cuts this year, but from a marketing positioning standpoint, we're being a little cautious on that, and we're positioning the portfolio to reflect that caution. I mean, someone asked me recently, is it possible that the Fed raises rates this year? I think it's highly unlikely that they raise rates this year. But depending on economic data, if there's a reacceleration in growth, if the administration really gets it right and there's a reacceleration in growth and inflation starts to tick higher, maybe there's a tightness in the labor market that causes wage inflation to start to tick higher, then it's very possible that we're talking about rate hikes in 2026. Again, I just want to emphasize not our base case right now. I'm just saying that it's a possibility if growth reaccelerates.
Yeah, and that's an interesting, topic there, Will, because, in my 19 years of working with local governments here in Colorado, the volatility of not only the fixed income markets, but also the equity markets or stock market, has been unprecedented through bank reform, through surging energy prices, through financial crisis, through a pandemic that we hope never comes back in our lifetime, any pandemic for that matter. So, I mean, the volatility in what local governments can do in Colorado, being 5 years and under in agencies and treasuries and 3 years and under in corporates. I mean, they're very restricted. So maybe you can comment a little bit on increased volatility and what that might mean from a local government investing standpoint, and primarily, here with CSLIP.
Yeah, the volatility is really interesting. So if you look at the MOVE index, which is a an index that was created in the late 80s, early 90s by this guy Harley Bassam. He was at Merrill Lynch at the time, and he looked at the price changes in 1 month Treasury options, and created an index very similar to the VIX, which measures stock option price volatility. If we look at that MOVE index, we have not seen it this high, consistently this high since the 1990s. And so you think about where we've been for the last 15 years, we've been either at zero or near zero on interest rates. And so I think a lot of folks have been sort of lulled into this sense of comfort that interest rates are very stable, they're very accommodative. And then 2022 happened. And that sort of tipped over, the glass of red wine, and it spilled all over the furniture. And now we're just like, holy smokes, what are we doing now? And I think that's where we're going to be for a while. So volatility has increased. Directionality has also, the uncertainty around direction has also increased, which I guess is another way of saying volatility. I mean, just look at, we've got a 40 basis point rally in 10-year yields over the last couple of weeks. It's been really remarkable. So what does that mean? What are we doing in the portfolios with that in mind? We're being very conservative around our positioning, and we're recognizing that we need to be comfortable with our positioning if interest rates are up or down by 50 or even 100 basis points. And I think that's everything the treasurers need to do. If you do extend out the curve, and you do lock up some duration, whether that's buying a bond to offset a liability, or whether that's buying a product that has longer duration, you need to stress test that. And then you need to recognize whether you're comfortable with the market moving higher by 50 or 100 basis points and you potentially having an unrealized loss in the portfolio. And so I think if you walk through those scenarios and you think about those outcomes and what they could mean to your reporting, if you have to report to your board or your boss or whoever that is, you just want to be able to walk through those scenarios and make sure people are comfortable with it. It's something that we're hearing from a lot from treasurers, is that this hesitancy or this extreme caution, based on what happened from 2021 to 2023. That was a tough year for a lot of folks, and we still have positions in the books where we're working off unrealized losses. And so I think we just need to be really diligent about running stress tests on our portfolios to make sure that we're comfortable. with those stress tests.
Excellent, excellent. And maybe this is a good time to just ask you a question that just kind of floated in my mind here, because our team here at State Street not only manages CSLIP, here in Colorado, but they do have another local government investment pool that they manage in California, serving as the investment advisor. And are you seeing any differences in, the two strategies? I know that the, maturity requirements and the state mandates are relatively similar, but are you seeing any outliers there that is changing a strategy between the two?
Yeah, we've got folks that are constantly reviewing guidelines, constantly thinking about like how they're going to, sort of get the most bang for their buck, to use the expression. And I've been in this specific role now for 11 years, and I've walked through many, many treasurers. I've walked through, investment options as they exist in the most liquid instruments, and then gradually moving out that risk curve to see what the opportunity set is. And as I walk people through that curve and then look at what the potential impact could be to NAVs, to drawdowns, to mark to markets, unrealized losses, gains, et cetera, it's very often treasurers come back to that liquidity and the love of that liquidity and wanting to make sure that they've got that liquidity locked up. It's always important to see what is potentially out there and what those returns can be. But more often, across this country and even around the world, that's where treasurers end up coming back. I mean, folks on this call, you've got cities, towns, counties, districts to run. And you just don't want to have to worry about that cash. So you really want to make sure that that cash is really stress test.
No, and that's a really good point. I think that speaks to the resources available to the local governments, not only participating in CSLIP, but here as well is really having that information, available to them. And, this might be a good time to talk about how you're positioning, the portfolio right now before we move on to, credit and consumer behavior. I think that this is probably a good segue into how you're positioning, CSLIP for the markets. Are you looking at fixed rate securities? Are you looking at floating? Are you looking, at commercial paper? What are you seeing out there?
Yeah, the alpha drivers in the portfolio right now are asset-backed commercial paper and other short-term commercial paper and CDs that we can buy at the front end of the curve that are really generating yield for the portfolio and also have very short maturity profiles. 30 days and shorter, 60 days and shorter. Those are names we really like. Just because of the uncertainty, we want to make sure we maintain liquidity and also the curve. That's what the curve's giving us right now. When we look further out the curve, we're looking for the highest quality names, and these are names that everybody knows, right? The biggest banks, the biggest financially important via institutions, or systemically important financial institutions, or SIFIs as they're referred to. And these are household names. You guys know these names. It's the JP Morgans, it's the Citibanks, the Bank of Americas, the Credit Agricoles, the Barclays. These are big, big global institutions that have a very diversified book of business, and those are the names that we like and we put into the portfolio. From a tactical standpoint, and just getting to your question about fixed rate versus floating rate, from a tactical standpoint, we really toggle between fixed and floating when we think the curve is giving us those opportunities to extend out, like they were in the month of January. And you folks probably saw my commentary. It was a lift-a-thon, as the vernacular goes, where everyone was just buying up everything because rates were really cheap in January and the curve was really giving us opportunity to extend out. And so we did. But as things have tightened in through that month of January and then into February, we're now looking both at fixed and floating. And we'll buy floating rate note when we just think fixed rate yields are too low. And then we can generate that alpha in the portfolio using floating rate note, which resets every day off of the SOFR index at some spread above the SOFR index. And that's something that we think puts the best value in the portfolio. As the opportunities present themselves, then we're going to move either in either or of those directions. But I don't know if I'm jumping the gun here, Ben, but just weaving that narrative into the credit side of things.
Yeah, that was my next question for you.
Yeah, we are cautious on credit. As I mentioned, though, the names that we're putting in the liquidity pool are the highest quality names in the marketplace. We are not worried about these names. These are, and you can see our holdings are public. You can look exactly what we're buying. These are very, very high quality names. You can see exactly what's going into the portfolio. And so, with that said, we feel very comfortable with that. Overall, in the marketplace, we are anticipating that the economy will slow. Granted, as I mentioned, we are starting to, there's some doubt that's being cast on that, but that was our view in 2024. And so we were cautious on credit. But that really has more to do with the longer term portfolios that can buy names that are single A, triple B, and names that pose a little bit more credit risk. For the CSLIP portfolio, what's in there is absolutely rock solid. But from an overall perspective, we think the credit markets are very rich. They're very expensive right now. In other words, credit spreads are very small. They're very tight versus what you could get in a treasury. And so we feel cautious on credit from that standpoint.
Sure, and I guess this is a good time to ask a question, about the efficiency of overnight, investing. Throughout my career, I've noticed that there are funds not only here in Colorado but also nationwide that'll use money market instruments or money market funds to invest overnight funds. Where I think, one of the advantages of having a massive institution like State Street would be repurchase agreements to make those overnight deposits that could come in after a wire cutoff or an ACH cutoff, which are just 1230 Mountain. But, maybe you can just speak to the value of repurchase agreements versus just putting it in a money market fund for overnight.
Yeah, absolutely. Yeah, I mean, I think what we want to do is make sure that the C-slip investors have the opportunity to get the best investment that's out there.
Hmm.
Repurchase agreements, as you describe, is where we are lending cash to a primary dealer, and then they're collateralizing it with treasuries or mortgage-backed securities, AAA government agency or government guaranteed debt. So we feel very comfortable with that risk. And by making this loan to that primary dealer, we get paid a very competitive rate. It's usually right around Fed funds. It's, right now it's a little bit higher because we're going into month end, so those rates tend to trade a little higher. And so that's the best opportunity that we see in the marketplace right now, that's not credit. Overnight deposits or short-term commercial papers, can also be cheap, but right now repos offer tremendous value. Later in the day, as you talked about, there could be an opportunity where a repo is available to us and we can make that investment with late day cash. But it's possible that that might not be there. And so then we would look at other alternatives. So I think the message here is that we employ a full spectrum of investments. And then based on the time of the day and the sort of where we are in the marketplace and what's being offered, we'll make a determination on what's best for CSLIP investors. So it's really all about having a whole basket of options to invest in, Ben. That's really what we pride ourselves.
Well, I mean, I think it, really speaks to how the capabilities as well as the resources, available to the CSLIP participants as well as all local governments in Colorado, because this board is very adamant about providing education, communication, service, guidance, expertise to all local governments, whether they're participants in CSLIP or not. So I think that, for just a behind the scenes look for everybody, that was a big determining factor on not only my recommendation to the board on why State Street, but I think that really, does separate us, from some of the other options out there. So I really appreciate, kind of explaining what repos are because everybody sees them, hardly anybody uses them, but they can be a great, vehicle. I actually had a call with somebody recently about this concept. So thanks for shedding some light on that. And it might be a good time to, if you're okay with it, kind of shift to, consumer behavior, with Doge and tariffs and interest rate forecasts and everything we've discussed up to this point. What are you seeing in the consumer behavior? What does that look like? I mean, spending, liquidity in the real estate market. I know Colorado, and I'll talk about this here in a minute, but real estate is a big problem here on affordability. So, what are you seeing?
Yeah, it's a great question. So the consumer is getting stretched. They are definitely getting stretched. They're getting stressed. We're seeing it in some of the revolving credit data. In other words, credit card balances are increasing, late payments are increasing. So the consumer is more stretched now than they have been. And listen, higher prices are to blame. It's been a situation where wage gains have been significant, but they have not kept pace with the cost of goods, housing, food, energy, consumer goods, consumer services. Those prices have gone up, and it's putting some pressure on the consumer. Now, what has kept the consumer spending is really two things. First, the US household has delevered dramatically from where we were in 2008.
Yeah.
There's been significant pay down of debt, indebtedness. Mortgages have been paid down significantly. Home equity lines have been paid down significantly. Credit card balances have stayed more or less the same. Auto loans have been paid down significantly, but it's really the delevering that we've seen in the housing market that has given the consumer a stronger footing to be able to manage through this high price, this high inflation environment. But it's been stressful, and it's starting to run the course. The thing that is keeping the consumer going right now is the job market. The job
Yeah.
market is still robust. Unemployment is still low, although we are starting to see more of a balance. It is taking longer to find a job than it has prior to COVID. And so there's a skills mismatch that exists in our economy. And so we need to make tracks on that. But the job market people are still employed. And as long as they're employed, then they will continue to spend. If we do start to see some layoffs, then we will start to see some stress, in more stress in the consumer, and that will be something that we'll have to keep an eye on.
Well, and this is a great time for our question from our friend Tara up in Grand County. Hi, Tara. Any thoughts on the federal layoffs being a part of the dual mandate with Federal Reserve, unemployment and price stability?
Yeah, it's a great question. So we know that the critical workforce, and that critical workforce are the folks at the Federal Reserve. We know that the critical workforce is those that are, you know, making Social Security payments. We know that the critical workforce is the ones that are really keeping the lights on. We know that those workers are not going to be impacted. And so that's something that I feel very confident that the Treasury will continue to issue debt and they'll continue to make those payments. And even we've seen some cascading messages that have come down from some of the Trump leadership where they're saying, don't worry about it. You're still employed. You still got your job, that sort of thing. So I think I'm not worried about that. But from a dual mandate standpoint, yes, the Fed is walking that line between price stability and employment. And that's something that I think that they're being very cautious on here. Recall back in the fall, they were more focused on the job market. And then all of a sudden, we got a really hot September payroll number. And then inflation started to tick up a little bit. Most recently, the January inflation data was a little bit stronger than expected. So now it feels as though we're tipping back towards prices. and therefore the Fed is feeling less confident about easing policy rate soon. And so that's where we are right now. That's why market expectations have lessened as far as lower Fed funds policy rates, because the Fed is starting to get a little worried about the inflation side of things, particularly as tariffs come in, and the uncertainty around tariffs, what those could do to prices. So that's something that I think the Fed is definitely keenly focused on right now.
Great. Well, I'm going to ask you my absolute favorite question to ask you. And for the audience, Will and his team over at State Street, we catch up on a weekly basis. And one of my favorite questions to ask him, but I am going to put a time limit on it because we got to go to Colorado.
Yeah.
What's keeping you up at night, Will?
Um, I think the uncertainty is what's keeping me up right now, and volatility. I think, what's going on is just, we just don't know. We just don't know the outcomes. And so when volatility increases and when uncertainty increases, I think everyone gets a little more defensive. As I've described, that's what we're doing. We're getting a little bit more defensive. We're taking risk down. We're lessening risk in the portfolios, and so that's what's keeping me up at night. Is just that, this increased volatility, increased uncertainty, and so we're taking some risk off the table.
Well, and thank you for that. And this is a good time to, remind, the local governments on the phone here or on the call, the podcast, I guess, as the younger generation would call it, is, safety is primary, then liquidity, and then yield. And from what I've noticed over my career, and Will, correct me if I'm stepping over my skis, but, with a lot of uncertainty, you want to be even more cautious about chasing yield.
Hmm.
And it may not be a bad thing to sacrifice a few basis points here or there, knowing that you can sleep at night where your tax money is invested, who it's invested with, who it's being administered by, and who of our board is governing us, because both Will and I report to our board, just like many of you out there, especially in special districts. You have a board, you have a city council, you have county commissioners, you have a board of trustees. So, I think that that's, really valuable. And this is probably a good time to transition over into the Colorado, economy. In the last 6 months, I've been on the road probably, I don't know, at least 5,000 miles. And many of you on this call I've seen recently. But one of the trends that, we're seeing out there, as well as, from the CU economic forecast, the business outlook economic forecast, which our chair, Bill Sutter, Boulder Valley School District, and myself contribute to annually, is starting with the municipalities. Sales tax revenues are relatively flat, around Colorado, even in some of the resort communities that are heavily based on tourism. And we heard from one of our friends down in the San Juans, their snow levels aren't nearly what we've seen in the West Elks, in the flat tops, in the I-70 corridor. So I think that, where we're at now from a sales tax revenue and budgetary standpoint is the average that we're hearing out there is anywhere to 1 to 2% increase over last year. But also, what we're hearing is budgets haven't really increased that much. So what I would say to that, what we're hearing from the demographer's office at the state of Colorado, is that we are expecting an increase in migration in to the state of Colorado. And everybody that's on this podcast, and Will has been inundated with this recently, is, I think the secret's been out about Colorado for a long time, but it's really now well known that this is a great place to live. But with that, everybody moving here all at once from certain states that we won't mention has really increased, the cost of living for everybody. It's grown the tax basis for local governments. That's great. But, you mentioned it earlier, Will, the strain, on consumers and the cost of housing, is extraordinary. I saw some figures that compares the millennial generation and Gen Z to the baby boomers. And I was born in 82, so I was right on the cusp. They call me a zennial, I guess. But what we're seeing is, I mean, these younger generations are being strained with these new costs of living that weren't around 30 or 40 years ago, like mortgage insurance, cell phone bills, car insurance. I mean, the insurance list goes on and on and on. And then you have daycare that is now 300% higher than what it was when I needed daycare in the early 80s, and the Nintendo generation, I guess, is what we can call us. So I think that, real estate is a real, big problem here in Colorado. And did that have an impact on slowing down the migration into Colorado? Well, the people that are moving here from the coast, this is still a cheap place for them to live, and I know that not a lot of people on, the podcast today want to hear that, but it's Colorado is not changing our mountains. They're not going away, so I do think that we will continue to see a migration in. And housing has cooled down, especially in the city and county of Denver, where my office is and my house a couple of blocks from here. We're not seeing the inventory levels increasing to a point where it's going to start lowering prices, but we have seen some price pressure there. I think that with a lot of the I-70 corridor and some of the mountain communities, that they may not see that, because somebody in the Roaring Fork Valley, a billionaire, doesn't care if their house costs 5 million more than it did 6 months ago. That's a day's worth of interest to some billionaires. But we're seeing that trickle down effect where the billionaires in Aspen are pushing, the 100 millionaires into Carbondale, and the 100 millionaires are pushing the millionaires down into Silt and Newcastle, in these areas. And that's not just, in the Roaring Fork Valley and the Grand Valley alone. That effect is being seen even on the Eastern Plains, because the high cost of living in the Denver metro area is pushing people east. And in fact, last year, Pueblo County and Chaffee County were two of the fastest growing counties in the state. So, I do think that local governments are going to continue to see an increase in tax base. And school districts last year had a record amount of bond issuances going out to the voter. There was over $6 billion in voter approval for bond issuances at school districts. I don't know what the tolerance is going to be of voters. I know that our fearless leader here in the city and county of Denver is going to approach the voters again with another large bond package. We've all seen the impact of the 16th Street Mall and now the buses going down Colfax and a lot of these areas. At what point are taxpayers going to say enough is enough? We don't know. I don't have the answer to that, but I do believe, with kind of the decreased forecast, or at least some of the components that you mentioned on the phone earlier, Will, that it's going to be interesting, to see what happens. I think the cost of borrowing for local governments isn't going to go down, but also on the budget forecast, at least with some of the people that I've talked to, I said, a conservative estimate would be anywhere from 3 to 3.25% on your overall investment returns. Even if you just stay in a cash fund, whether it's CSLIP or some of the other options out there, the majority of us are paying 4.3 to 4.5. So you are going to come in over your in forecasted investment earnings, but your cost of borrowing isn't going to go down maybe like what we expected. So, all in all, the health of the Colorado economy, is doing great, and related to us with CSLIP, we really just started last May, and to have the interest that we do now in, well over $220 million in the portfolio, as well as having full transparency with our holdings out there. We're not, hiding the fact that, our yield is a little lower than some of the others right now, but, there's a lot of factors with that. I think that, people are really seeing the approach that we're taking, which is, again, being a part of your community, understanding your community, better than a lot of the options that you have out there. After spending 19 years in many of the offices that are here, I think that you guys really deserve a high degree of attention. So, this is a quick reminder that CSLIP is available for you. A lot of people are really excited about the approach that we're taking with the education, who our board of trustees is, who our service providers are. Again, having the privilege of having Will and your team, the fourth largest asset manager in the world, allocating the portfolio, that makes me sleep better at night. I can tell you that. So I think that, this fund is really becoming a viable option for a lot of local governments. And a quick reminder, we are available to you, whether you're a participant or not. As many of you know that have met me, and for the ones that haven't, we love what we do here. We want to help you. We want to be a resource for you. So with that brief commercial, I'm not a salesperson, I'm an administrator, but with that brief commercial there, we want to take a pause here and open it up to questions. We did, address, Tara Thompson's question up there in Grand County. Thank you again for sending that in. But, don't be bashful about asking questions. I think as you've seen by now that Will, and his team at State Street, big name, but they take a really small name approach, to working with local governments. So with that, and we do have a couple of board members on the phone. I'm not sure if, they wanted to mention anything, but this time is for you. This isn't a commercial for us. This is for you. So please feel free to either type a question in the chat or feel free to chime in. We'll open up the floor there. And don't everybody speak at once.
So Ben, I have a question for you.
Please.
What are the sort of top concerns as you travel around the great state? What are the top concerns that you're getting in those conversations with those treasurers?
So there's the number one between the finance directors, the CFOs, the county treasurers, the directors of finance and administration, all the titles out there. The number one concern is housing, the cost of housing. And this is my own personal opinion, and I may strike some controversy here, but VRBO, Airbnb, short-term rentals have not done us a favor in terms of housing supply, especially for those younger generations. The kids coming out of college, regardless of their financial situation, I feel for them. I really do. Even to buy a one-bedroom studio where they're not paying rent, where they're building equity, and a lot of the things that our generations have become accustomed to in this country is going away. And I think a lot of these communities, at least from what I hear out there, are concerned about what the future of their communities look like. Is there going to be enough of a draw for the younger generation, if they leave to go to college, to come back? Is there going to be enough of the infrastructure and a need or a desire for them to come back to some of the small, medium, and large municipalities outside of the Front Range? But what does that look like? Cost of debt, the issuance out there, if they have any bond, initiatives up for either voter approval, projects, what that's going to look like. But also, finding good help. I think that reigns eh, as a plague in all industries, not just at the local government level. But I do hear often around the state of Colorado that it's really hard to fill these positions. It's hard to find people that want to be in the office if they have a 5 day in the office policy. I think even some of the remote positions, are it's really hard to find that talent. And I think that we're really going to have a massive changing of the guard. There's going to be record retirings happening, not only here in Colorado, but nationwide. And are those next generations going to be either capable, qualified, educated to step into these, positions? I mean, I think that there is a lot of uncertainty. So uncertainty is probably one of the other broad range topics that I hear out there often is, wow, our future is really uncertain. Our cost of housing is really uncertain. Our talent pool is uncertain. Our interest rates are uncertain. The amount of resources we get for people to help us is uncertain. And I look at, some of the counties. I mean, all you have to be a county treasurer in Colorado is 18 and a resident of that county for a year. And all of a sudden they win their election. They're stepped into, hey, here's hundreds of millions of dollars or tens of millions of dollars that you're in charge of investing. Who do I even call? Where do I start? Some of those things are what we're hearing out there. But overall, well, in hitting the road as much as I do and being a part of these communities as much as I am, I'm not concerned about any parts of the state having dramatic economic forces working against them because of the growth of our tax base. Other than what I had mentioned, with the housing and filling positions and turnover and, all these things out there. I mean, it's, on any given day, there's always a crisis of the week. One of our service providers, we always joke about that. What's the crisis of the week this week? So it remains to be seen, but am I worried about the health of Colorado economically compared to other states in this great nation? No, I'm not. We really have a unique lifestyle here. And what's, a point that I really want to make is that the Front Range is not Colorado. Okay. There is a lot of Colorado outside of the Denver metro area. And Baca County down in the, southeast corner of the state is very different than Rio Blanco County in the northwest part of the state. And really, understanding those unique differences of the geographic area of Colorado, is I think what really is an important component that not only our team brings, but people need to, really be aware of. And, it's frustrating sometimes to see the voting base, in the Front Range really making decisions based on the amount of votes that they have and the population to control what happens in other parts of the state. So, I mean, these are the, the big topics that I'm hearing out there. And I know that was a very long-winded answer, but, I think that those are the hot topics right now.
Cool. Did you see the question from Vicky Edwards on ICMA?
A remote but possible clawback of SLFRF unspent funds. Maybe Vicky help me, and hi Vicky, by the way. Maybe help me understand what SLFRF is. You can either chime in verbally or you can put it in the chat. I just want to make sure we address that. Oh, funds from ARPA. That's a really interesting question, and Will, I want to hear your perspective on this. But the impact that the ARPA funds had on local governments during the pandemic, I refer to it as helicopter money. All of a sudden, these helicopters were going over these communities and dropping big boxes of money on local governments and saying, "Hey, you need to spend this. We can't tell you which way you can invest it. We can't tell you how quite to spend it yet. We don't know how long you have to spend it, other than the kind of 3 year soft thing." So that was a really large impact out there. And Vicky, that's a great question because a lot of those funds are, either being spent down or they're not coming back. So I think that that did have a pretty positive impact, from a fiscal standing spending standpoint and resources available to local governments. But what are you seeing on that on a national level, Will?
On a national level, it's the a lot of it is contracted, and so the money can't be clawed back without some sort of a lawsuit. And I have started to hear there being some challenges where they do want to claw back some money. If the money is not contracted or is sort of floating out there waiting, then I think there could be some challenges around that. But I know that they're trying to cancel a lot of stuff that's already like it's already done, like it's already set. So I think this is another situation where there's a lot of uncertainty around it. And, do we have this money? Do we not have this money? Can we spend this money? Can we not spend this money? So, Vicky, I'm sorry that I can't give you more of a definitive answer, but I think this is where we end up in this situation where there's a lot of uncertainty about how this money could be spent.
Yeah, and that's great. And I just saw a question pop up on the chat from Villa AL, and I think I know who that is, but I won't call him out directly. Who's going to help that new generation? Well, I think their parents have already done a great job of helping them as much as they can. I think that and this is just a lot of opinion here, I think that that road has been set up pretty well for them, including the older millennials. There's a term out there called snowplow parents. I've seen it, but I think that this new generation needs to help themselves. I think that they need to really shift what this looks like. And they've done everything they've been told, right? Go to college, rack up all this debt, and you'll come out making $50,000 a year. Yay. Well, I think that, personally, what I would recommend to anybody in this new generation is find a way to start a business, because this country incentivizes and rewards people that start a business from a resources and taxation standpoint. Some people may disagree with me on that, but I think the days of, climbing a corporate ladder at a company that has 500,000 employees, no offense, Will, but I think that that path and those ladder rungs have become much wider for them to climb. So I think that this generation needs to help themselves, and I think that they really need to roll up their sleeves and embrace the fact that life is not easy. Life is not fair. There's always somebody bigger, faster, and stronger than you. And how are you going to differentiate yourselves individually to better what your terrible deck of cards that has been dealt to you, both economically and socially, in a lot of different ways? I and I agree with that follow-up comment there that we need to provide more opportunities for small businesses. Absolutely. I'm a walking example of that. As Centennial Government Advisors, we are the administrator of CSLIP, and I'm a one person, operation, which I've surrounded myself with great people, but, I am a small business owner. And I do think that that is, a separation of us and some of the other funds is, that we have an independent approach with that. And, I agree with you that, some parents can help their children. Growing up in inner city Denver, I mean, my parents did everything they could for me, but it really took me finding something I was interested in and passionate about, wanting to learn as much as I could. And I'm still learning every day. I get the privilege to learn from Will and his team, some of the brightest in the business on a weekly basis and sometimes on a daily basis. I'm bugging these guys with, hey, what do you think about this? So it's tough, and speaking from that, growing up in inner city schools and seeing, some of the wealthiest people in the state of Colorado children and the poorest in the state of Colorado children all in the same classroom, learning how to work together. To me, that's education. So it's really, trying to find that. it's not easy, and I think that, again, the deck of cards is that's been dealt to some of the younger, people coming out of college or trade schools or, things of that nature has been, tough. And who knows what things are going to look like in the government sector. The government sector here in Colorado, will, for your, information, and for Bill Sutter, our chair, he was there in the room. The government sector here in Colorado is the fastest growing sector, here in Colorado. So, um, it's tough. And I think Tara just made a great, comment here on the chat that, it's hard to compete with wage with private sector. That's another challenge, and one of the things that I feel the most for local governments here in Colorado is you guys are kind of like the offensive line in football, where you have a critical role to the success of the team, but very rarely do fans pat you on the back and say, "Hey, great job for opening up that hole for the running back or that throwing lane for the quarterback." And you most certainly don't get a bonus for making your entity 2 million in interest income versus 1.5. So I think that, there are a lot of, components at play here, and it's tough. I mean, I think that the future is bright, but it's not as glaringly bright as what we may have seen 20 years ago. Anybody else brave enough to ask a question? Would any of our board members like to say a few words before we wrap this up? We want to get you back to your critical jobs on the offensive line and in the front, lines, but we also, want to open this up to you. Okay. Well, I think having said that, our goal is to continue to do these, and if you have topics that you want us to discuss, send them my way. If you need help looking at things, I'm happy to look at it with you. Sit down, be an extension of your team, be a part of your desk and saying, "Hey, if I was in your shoes, this is what I'd be doing. These are the things that I'd avoid." So don't hesitate to reach out to us. We are a resource for you. Our board is a resource for you. They're all your peers. Will and I report to them. They govern this fund based off of what they feel is in your best interest. So we are here to help you in any way possible. And with my 19 years of experience, Will's 33 years of experience, before we even get into the team, there's hundreds of years of experience here in working with public entities and in fixed income. We're here to help. So don't hesitate to reach out. And we really appreciate your time today. And we look forward to, being a resource for you down the road, and anything we can do to help you, we're only a phone call away. So thank you for your time today. Will, do you have any closing?
No, thanks, Ben. Appreciate being on and looking forward to the next one.
All right. Thank you. Everybody have a great day.
Cheers.
Bye-bye.